welcome to the Mortgage Rate Weekly Market Update for the week of September 10th, 2018. Hello, I'm John Thomas with Prime Residential Mortgage. Here to give you an update. Well, last week, mortgage rates did move higher. If we take a look at the bond chart on the screen, you can see mortgage bonds hit the high that we've seen back about August 20th, that week of August 20th. Since then, they were not able to break above that tough ceiling of resistance. They were turned lower, sold off, found a floor of support, but then broke through that again. And this week on Tuesday, you can see the giant red candle down. They fell below support, followed through on Wednesday, but did find a floor of support. Were able to rally higher off of that on Thursday. You can see with the green candle there. But then on Friday, after the jobs report came out, mortgage bonds and the stock market did not like the report. Bonds sold off. You can see that giant red candle down. Broke through the 100-day moving average, broke below floor of support. They've got a little bit of room to go lower to find the next floor of support. So the technicals right now are not good. Mortgage bonds have broken through a couple layers of support. The technicals have changed to being a sell-off in the bond market. So until we can find a good floor of support and see the bonds rally off of that and confirm, we're going to recommend locking your mortgage interest rate because rates could move higher before we see them stabilize and see if they can try and move lower. So go ahead, lock in your mortgage rate to start the week. If we dig into the economic news, the big news last week was the jobs report for August 2018 released on Friday. 201,000 jobs created. That was better than 195,000 jobs predicted, which on the face of it should have been a good report. But if we dig in, there was a revision of 50,000 less jobs to June and July's numbers. So those numbers went down on the revision. So that's not great. The unemployment rate, though, did stay stable at 3.9%, which is the lowest since May of 2018. But again, if we dig into that, the jobs report is made from two different surveys. The first survey is the business survey. That's used for the headline number, which was the 201,000 jobs created. The second survey is called the household survey, and that's used to come up with the unemployment rate, which was 3.9%. But in the household survey, it had us losing 423,000 jobs. But the reason why the unemployment rate stayed steady is what counteracted that was we had 469,000 people drop out of the workforce, which is not the reason you want the unemployment to stay the same. So we lost 423,000 jobs, which means unemployment rate would have gone up, but 469,000 people dropped out of the workforce. So that offset, unemployment rate stayed the same. So on the surface looks good, but when you dig in, not good. That's not the way you want to keep unemployment the same. And that's shown by the labor force participation rate, which dropped from 62.9% down to 62.7%. So it measures the number of people that are eligibly working or actually working. So that shows us the unemployment rate stayed the same, and not for a good reason. It's because the workforce shrank as we lost the jobs. Now, but the reason the mortgage bonds sold off on Friday was because when we dig into the average hourly earnings, it increased by 0.4%, and year over year is at 2.9%. That's the highest wage inflation in 9.5 years. So wage inflation is bad news for mortgage bonds because it erodes the value of those bonds. So that's why mortgage bonds sold off on Friday, and that's why we saw the week end with higher mortgage rates. So the lot in the report, headlines look good. We dig in, not a great report there. So we'll have to see how this plays out for September, see if the trend continues or if it's a one-off. Because when we dig into the weekly initial jobless claims, which came out on Thursday, they dropped 10,000 claims to 203,000 claims for the week. That's the lowest level in 49 years, which is very strong. So that is telling us the labor market's still doing very good. Employers are holding on to good employees, and they're having a tough time finding new good employees. So that is kind of contrary to the jobs report in some sense, but it does support a low unemployment rate of 3.9%. Now, in the week ahead, we've got wholesale inflation, producer price index coming out, and consumer inflation being measured by the consumer price index. So those two will give us another read on inflation. We'll see if those come out hotter. That's going to be on the back of the wage inflation. We could see bonds sell off. That's why we're locking. If they come out tame, that would be good news. Then we've got week initial jobless claims, and then we've got retail sales and consumer sentiment on Friday. They've been strong. We'll see if they continue to be strong at the end of this week. Now, in the housing news, CoreLogic released their home price index for July of 2018. Home prices are up 0.3% from June, and year over year they're up 6.2%. Now, there's some bad news in the media, home prices going down. They're not going down because the home price appreciation is decelerating. What that means is the rate at which it's increasing is slowing, but home prices are still increasing. For example, home price appreciation year over year in May was 7.1%. In June, it was 6.8%, and now in July, it's 6.2%. So home prices went up each month. It's the rate at which they're going up is slowing, and it's slowing down to a more sustainable level, so that's good. That means if it slows down to that 5-6% range, that can go on for a long time. So they're not dropping, contrary to what the press might be saying. CoreLogic predicted home prices on average to be up 5.1% next July. So July 2019, 5.1% price appreciation. So continuing to slow, but home prices still going up. So that means it's still a great time to get out there and own a home. It's an appreciating investment. You're going to pay the mortgage either way. It's whether you want to pay yours or your landlord's. Now in the local news, we got in Delaware, we got some first-time homebuyer seminars coming up. Next one in Newark is Saturday, September 22nd from 10 a.m. to noon at the Christiana Hilton Hotel. And then the following Wednesday, the 26th, we are in Wilmington, Delaware from 6 p.m. to 8 p.m. at Independent Small eXp Realty Office. And then we're back in Dover on Saturday, the 29th from 10 a.m. to noon at the Dover Holiday Inn. You can register for either one of those events. Give us a call in the office, 302-703-0727, or online, www.delawarehomebuyerSeminar.com. Now in Maryland, we got two events. This Saturday, the 15th, 10 a.m. to noon, we are in Hyattsville, Maryland at the College Park Marriott Hotel and Conference Room. And then we're back there again Saturday, October 27th, 10 a.m. to noon. You can register for either one of those events. Give us a call at 410-412-3319 or online, www.marylandhomebuyerseminars.com. Look forward to seeing you guys next week.